All right, welcome to The Explainer. Today, we're tearing into Bristol Myers Squibb's Q1 2026 financials to see exactly how this healthcare titan is managing a massive, and I mean massive, internal transition. This is a genuinely fascinating look at a company caught right between expiring legacy patents and a brand new wave of innovative therapies.
Let's kick things off by just acknowledging the sheer scale we're dealing with here. We're talking about a company with a market cap of $117.5 billion. When a beast of this size attempts to pivot its core revenue streams, it does not happen overnight. It is literally like trying to turn a massive cargo ship. Every single percentage point of growth or decline represents billions of dollars, and as we're going to see today, that transition is fully underway.
To make sense of this transitioning titan, we've got a clear roadmap for today. We'll snapshot the Q1 financials, stack up the growth versus legacy portfolios, check under the hood of their balance sheet, talk dividends, and then wrap it all up with future guidance and pipeline catalysts.
So, let's jump right into Section 1, the Q1 2026 financial snapshot. Let's see how they actually performed at the highest level in the first 3 months of the year. The big headline? Steady momentum. Total revenue ticked up 3% year over year, landing right around $11.49 billion. Now, if you strip out foreign exchange impacts, we're looking at a 1% increase. And sure, 3% might sound a little modest at first glance, but in the pharma industry, where major legacy drugs are getting hammered by generic competition, delivering consistent top-line growth is a critical win. CEO Christopher Boner even pointed out that this reflects some seriously disciplined execution across the board.
Now, the earnings per share, this tells a really interesting story. You've got your GAAP EPS at $1.31, but the non-GAAP EPS sits up at $1.58. Both of those figures actually factor in a 3-cent net impact from acquired in-process R&D charges and licensing income. But that gap between the two numbers, that mostly comes down to the amortization of acquired intangible assets. It's a great reminder that Bristol Myers Squibb hasn't just been sitting around, they've been aggressively acquiring assets to fuel this exact transition.
Moving right along to Section 2, growth versus legacy portfolios. Because honestly, this is the real story of the company right now. It's basically a tale of two vastly different operational profiles, and you can see the internal friction perfectly right here. Look at those top two. You have massive global revenue expansion in newer therapies. Camzyos is up an unbelievable 97% year over year, and Breyanzi jumped 56%. But then, look at the legacy stuff. Those huge gains are actively doing battle with steep, generic-driven declines. Revlimid is down 63%, Sprycel down 58%. I mean, it is a literal tug-of-war on their income statement. And here is the absolute crucial takeaway. The crossover has officially happened. The growth portfolio, which surged 12% to $6.2 billion, has successfully overtaken the legacy portfolio, which dropped 6% to $5.3 billion. If you remember one thing from this explainer, make it this. The new medicines are now generating more total revenue than the older, expiring ones. It proves their strategy is actually working right now to carry the top line forward. Which brings us to Section 3, debt and balance sheet. We really need to look at how they're actually financing this massive operational pivot.
Before we throw numbers around, let's quickly refresh on financial leverage, specifically the debt-to-equity ratio. It's just long-term debt divided by shareholders' equity. For a capital-heavy pharma company that relies on huge R&D budgets and acquisitions, this is a make-or-break metric. It tells us exactly how much the company is leaning on borrowed money versus its own funds to operate.
So for the quarter ending March 31st, 2026, their debt-to-equity ratio sat at 2.21. That reflects a pretty hefty $42.15 billion in long-term debt. Now, anytime you see a ratio over 2, it tells you the company is heavily leveraged. They've borrowed quite a bit to fund those acquisitions and pipelines we just talked about, effectively buying the growth portfolio they so desperately needed to replace the legacy drugs. But you've got to look at both sides of the coin, right? They are still highly liquid. We're talking an impressive $10.85 billion in cash, cash equivalents, and marketable debt securities just sitting there. So yes, the debt load is substantial for sure, but this massive liquidity buffer helps them manage those obligations without suddenly having to choke off their investments into new science. All right, let's pivot to Section 4, the dividend profile, or, the main reason a lot of retail investors are patiently holding this stock through the transition.
And it's a solid profile. We're looking at a really attractive 4.38% dividend yield, paying out $2.52 per share annually. What really stands out to me, though, is that 11.38% 5-year growth rate and their 4-year streak of consecutive increases. With a payout ratio hovering just over 71%, they're striking a nice balance. They're returning a lot of capital to shareholders right now, while still keeping enough powder dry to handle their debt and keep funding future growth.
Finally, Section 5, Future Guidance and Pipeline. Let's see what the rest of the year actually looks like for them.
Management is definitely projecting confidence. CEO Christopher Berner reaffirmed their 2026 guidance, expecting total revenues to land somewhere between $46 and $47.5 billion, with non-GAAP EPS between $6.05 and $6.35. But the real kicker here is they specifically noted they are confidently trending toward the upper end of those ranges. Plus, gross margins are expected to hold nice and steady around that 69 to 70% mark.
Looking down the road, if you're a shareholder, mark your calendars. You've got a July 2nd record date if you want to catch that August 3rd dividend payment. And moving past just the financials, everyone is going to be watching closely for late-stage clinical readouts at major events like the ASCO Medical Conference later in 2026. That's really going to showcase the strength of their upcoming oncology pipeline.
So I'm going to leave you with the multi-billion-dollar question to chew on. Can Bristol Myers Squibb's growth portfolio continue to outpace its legacy declines? As we've seen today, they finally crossed that tipping point this quarter, which is absolutely huge. But the entire future of this pharma titan rests entirely on their ability to execute, innovate, and get new therapies out the door faster than those old patents expire. Thanks for joining me on this explainer, and I'll catch you next time.